Hello, my name is Rohit Jain. I'm the founder of investorlaw.com. Today I'm going to talk about the debt ratios, that is the debt equity ratio and interest coverage ratio, which are required for the safety analysis of stocks. First, let's talk about the debt equity ratio. The debt equity ratio is calculated as the total debt, that is the total loan taken up by the company divided by its net worth. This ratio helps us in comparing the debt over a company in relation to its net worth. For example, if the debt equity ratio for a company is equal to 1, it means that the company has taken up as much debt as is the net worth of the company. Debt equity ratio is calculated by adding the short term borrowings and long term borrowings and dividing the sum by its net worth. A high debt equity ratio is a bad sign for the safety of investment. A company which has high debt in comparison to its net worth has to spend a large portion of its profit in paying off the interest and the principal amount. If the debt is decreasing over a period of time, it is a good sign. Vice versa, an increasing debt is a bad sign. Ideally, we should look at the companies which have very less debt equity ratio. I personally prefer a debt equity ratio of less than 0.25. However, in exceptional cases, we can accept a bit higher debt equity ratio as well, depending upon the company's industry. Now we come to the interest coverage ratio, which also depends upon the debt taken up by the company. Interest coverage ratio helps us in measuring the capacity of the company to meet its interest payments with its operating income. It is calculated as EBIT, that is earnings before interest and tax, divided by interest. Thus, if the interest coverage ratio for a company is 5, it means that the company's EBIT is 5 times that of interest it pays for the debt. We need to check the interest coverage ratio for those companies which have significant amount of debt in comparison to their net worth. Ideally, one should prefer the companies which have interest coverage ratio more than 5. We should definitely avoid investing in companies which have interest coverage ratio less than 2.5. When the company's debt equity ratio increases, the interest coverage ratio comes down. Vice versa, when the debt equity ratio decreases, the interest coverage ratio goes up. The companies for which these ratios consistently remain better than the recommended threshold should be considered for further analysis. The companies for which these ratios cross the threshold value quite often should be definitely avoided. Now we shall see a couple of examples for these ratios. Let's look at the debt ratios for JK Tyres. As we can see, the latest debt equity ratio for JK Tyres for the year 2019 is 2.52. Over the past 10 years, the debt equity ratio has fluctuated between 1.25 and 2.5. It means that the company has constantly required infusion of capital for its operations. The current value of debt equity ratio, that is 2.5, is higher than our tolerated threshold of 0.5. Now let's look at the interest coverage ratio of JK Tyres. We see that the latest interest coverage ratio for JK Tyres for the year 2019 is 1.52, which is much below our tolerated threshold of 2.5. An interest coverage ratio of 1.52 means that the company's earnings before interest and taxes are just above 1.5 times that of its interest obligations. This means that a large part of company's operating income is being spent in meeting interest payments. If the company's operating income decreases even a bit in such a scenario, it will have a huge impact on the company's net profit. Thus, an investment into such a company is a risky investment for investors. Now, let's look at the same ratios for TCS. The latest debt equity ratio for TCS is 0. Over the past 10 years, the maximum debt equity ratio for TCS has been 0.06, and that was also more than 10 years ago. It means that TCS does not need debt to fund its operations and growth. It probably would have ample cash on its balance sheet. Such companies are well equipped to face any short-term troubles such as the one we are facing nowadays in the form of COVID-19. For the companies which have debt equity ratio less than 0.1, we should not need to look at their interest coverage ratio. However, we can see that the latest interest coverage ratio for TCS is 210.91, which means that out of its operating profit, the company has to pay less than 0.5% for interest payments. Now, the question arises, if the company does not have debt, then why is it paying interest? The answer is that the company would have very small amount of debt on its balance sheet, which would be less than 0.01, and thus it is shown up as 0 after rounding off. For the company which won't be paying any interest, there won't be any value for interest coverage ratio for that year. Infosys is one such example. Let's draw a few points of conclusion for this video. We can conclude that the companies which have high debt equity ratio and low interest coverage ratio are riskier investments than the one that have low debt equity ratio and high interest coverage ratio. The companies like TCS, which have low debt, are better placed to face challenges arising within the economy or the industry. Having said that, it does not mean that we can invest in any company which has low debt equity ratio. The debt ratios are just rejection criteria. We can only reject the companies on the basis of these. If we find these ratios to be satisfactory, we can continue our analysis for such companies, such as valuation analysis, to determine whether they satisfy other criteria as well. I will cover these aspects in future videos. I hope this video has helped you in understanding the debt ratios, which are critical for safety analysis of a company. If you found this video helpful, please let us know about it in the comment box. We shall post more of such videos to help you make correct decisions in the stock market. If you would like to be notified for our future videos, please subscribe to our YouTube channel as well. Thank you very much. All the best with investing.